Imagine deliberately firing your biggest customer, like actively turning away millions of packages, just, on purpose.
It sounds completely counterintuitive, right?
I mean, who does that? But in the first quarter of 2026, that is exactly what UPS did.
They absolutely did.
So today, we are welcoming you to a custom deep dive to decode the UPS first quarter 2026 earnings release, which just dropped recently on April 28th, 2026.
And we are not here to just read a spreadsheet to you.
No, definitely not. We are looking at a real-time blueprint of a massive corporate pivot. It's a document that helps us understand why shrinking a business might actually be the ultimate master plan for growth.
Yeah, it's a radical shift in corporate philosophy, because this report is not just some historical record of revenue.
Right.
It is fundamentally a story about how UPS is choosing to make money moving forward. We are looking at a company making very deliberate, highly disruptive choices to restructure its physical and financial reality.
They're essentially prioritizing margin over raw scale. Right.
Exactly. They are choosing profitability over just being the biggest.
Okay, let's unpack this. Because reading this earnings report is kind of like checking the pulse of the global economy. But, instead of blood pressure, we're measuring millions of cardboard boxes in vast logistics networks spanning across more than 200 countries.
Which is an incredible amount of infrastructure to manage.
Yeah, the sheer scale of that reality is just staggering to begin with. So let's lay out the top-line facts for the first quarter of 2026.
Let's do it.
UPS brought in consolidated revenues of $21.2 billion.
Massive.
Huge. They posted an operating profit of $1.27 billion, or $1.32 billion on an adjusted basis, and they reported diluted earnings per share of $1.02.
Those are undeniably massive figures. But as you dig into the actual breakdown, there is this glaring contradiction sitting right in the middle of the U.S. domestic segment.
Yeah, this is the part that really caught my eye. The U.S. domestic revenue actually dropped by 2.3%, down to $14.1 billion.
Right, and that was driven by an expected decline in volume.
Meaning they delivered significantly fewer packages.
Yes.
But, and here's the crazy part, their revenue per piece actually grew by 6.5%.
Which is a huge jump.
It is. It's like a restaurant deliberately serving fewer customers, but somehow making everyone who sits down order the most expensive steak on the menu.
That is a great way to think about it.
But I have to ask, why would a logistics giant, a company whose entire history is basically built on scale, ever want to deliver fewer packages?
What's fascinating here is that this drop in volume isn't an accident. It ties directly to a very specific line buried in the report.
Oh, yeah.
Yeah. They explicitly mention the strategic execution of planned volume declines from our largest customer.
Planned volume declines.
Right. They are intentionally shedding volume.
So they are actively telling their biggest client, no thanks, we don't want to carry these boxes. I mean, that seems like leaving billions of dollars on the table for competitors to just scoop up.
It absolutely looks like a huge concession. That is, until you look at the physical physics of their business.
The physics of it.
Yeah. UPS is shifting its entire focus away from sheer volume to achieve a targeted 4.0% adjusted operating margin domestically. Treat their logistics network like a city's highway system.
Okay, I'm with you.
The cheap, bulky, low-margin packages from a massive e-commerce giant, those are the semi-trucks.
Oh, okay.
They cause traffic jams, they take up enormous cubic volume inside a delivery vehicle, and they require more physical labor to load and unload.
They probably burn more fuel, too.
Exactly. They max out the physical capacity of the truck way before they max out the weight limit or, the profit potential.
Oh, wow. So they are filling up the space without actually bringing in the money.
Right. And at the end of the day, those bulky items just don't leave much actual profit on the table because that massive customer negotiated rock-bottom shipping rates based on their sheer volume.
Right. They get the bulk discount.
By banning those low-margin semi-trucks, UPS is basically clearing the fast lane exclusively for the sports cars.
The sports cars being.
Yeah. The high-margin, critical deliveries. Things like healthcare supplies, premium retail, or specialized B2B freight.
So every box that remains in the brown truck is paying a higher fare to secure that limited shelf space.
You've got it.
That completely explains the revenue per piece jumping 6.5%. It's It's a classic shrink-to-grow strategy.
Exactly.
You sacrifice the top-line revenue by firing your least profitable business, which instantly boosts your actual operating margin.
But, executing a shrink-to-grow strategy isn't like just pushing a software update.
Right, it's the physical world.
Yeah, you can't just delete a massive client without physically dismantling the warehouses built to serve them. When you intentionally shed that massive volume from your largest customer, you suddenly have enormous empty spaces in your network.
Oh, I didn't even think about that.
You are heating, lighting, and staffing sorting facilities that are maybe only running at 60% capacity.
Which means you have to fundamentally change how the physical network operates. And here's where it gets really interesting. UPS isn't a tech startup where you can just pivot in an afternoon. They have 460,000 employees.
A massive workforce.
Yeah, fleets of aircraft, thousands of ground vehicles, massive sorting hubs. And the report outlines this enormous internal restructuring initiative called Network Reconfiguration and Efficiency Reimagined.
Quite the title.
Right. And in the first quarter alone, UPS took $42 million in after-tax transformation charges.
Just in one quarter.
Just Q1. Now, they did achieve $600 million in program cost savings this quarter.
Which is good.
It is. But they are targeting a massive $3 billion in full year-over-year cost savings for 2026.
$3 billion is a staggering amount of money to cut.
Yeah, and getting there involves closing facilities and a crazy $1.2 billion in projected costs specifically related to the driver choice program.
Right, the driver choice program.
I mean, I have to ask you, are these just typical corporate layoffs dressed up in fancy management, speak to appease Wall Street? Or is this a total rewiring of the company? Like, what does an end-to-end process redesign actually look like for a company of 500,000 people?
If we connect this to the bigger picture, we can see this is a multi-year physical rewiring of the corporation. The sources actually provide a really great timeline for this.
Oh, really?
Yeah.
How far back does it go?
Well, previous phases, they were named Transformation 2.0, and Fit to Serve those finished in 2025.
Okay.
But those were largely administrative, reducing management layers, right-sizing the corporate structure, updating legacy IT systems.
Well, white-collar stuff.
Exactly. But this current phase, which runs until 2027, is entirely about automation and operational sort consolidation in the U.S. domestic network.
It's about the physical boxes.
Yes. It is about the physical choreography of the boxes.
Because, I mean, you don't spend over $1 billion on something called the driver choice program just to tweak a few delivery routes.
No, you spend that money because reshaping a heavily unionized physical network of aircraft and ground vehicles is incredibly capital intensive.
Okay.
You can't just fire 10,000 drivers and close a hub overnight.
Right, there are contracts.
Exactly. You have to offer early retirements, buy out union contracts, pay severance packages, and you have to physically relocate massive automated sorting machinery from one state to another.
Oh, wow.
Closing a hub in one city means you have to redesign the flight paths and the truck schedules for a dozen other cities just to ensure your service guarantees are still met.
It's like a giant puzzle. So they are essentially spending money now, taking these non-GAAP adjusted charges to strip out the structural built-in costs of the business.
Exactly.
By 2027, they want a leaner, highly automated machine, perfectly calibrated for those expensive high-margin packages we discussed.
That is the ultimate goal, yes.
But while the U.S. market is undergoing this incredibly painful, expensive, and complex physical reconfiguration, the rest of the world is telling a completely different story for UPS.
Yeah, the divergence between the domestic and international numbers in this report really highlights two completely different operational realities.
Let's look at the international segment. Because while the U.S. domestic revenue dropped, international revenue actually increased by 3.8%.
Right.
Up to $4.54 billion. And that was driven by an absolute rocket ship of a metric. A 10.7% jump in revenue per piece.
Which is phenomenal growth.
It's wild. And because of that, their international operating function isn't the 4.0% we saw in the U.S. It is a highly profitable 12.0%.
Triple the margin.
Exactly. Now, conversely, their supply chain solutions segment saw revenue drop by 6.5%. And the report explicitly blames a decline in mail innovations volume for that.
That's a very specific call out.
Right. So what does this all mean? Is the international market simply willing to pay a massive premium right now, or is something structurally different happening outside the U.S. borders?
This raises an important question about the fundamental nature of different types of logistics, because global trade, cross-border shipping, international air freight, they are inherently complex.
Very complex.
You are dealing with customs clearance, international trade regulations, long-haul aviation. Because the barrier to entry is so incredibly high and the service is so specialized, international shipping naturally commands significantly higher pricing power.
You can't just hire a guy with a van to fly a package to Germany.
Exactly. If a manufacturer needs a critical semiconductor flown from Germany to Japan to keep a production line running, they are entirely price inelastic.
Meaning they don't care what it costs.
Right. They will pay an absolute premium for guaranteed reliability.
So it's the sports car lane we talked about earlier, but on a global scale.
Precisely. Now, contrast that highly specialized international freight with the specific domestic segment that is dropping, which is mail innovations.
Okay, what exactly is mail innovations?
Mail innovations is a service where UPS handles the long-haul transport of lightweight, lower-value packages. Think small e-commerce items, catalogs, cheap apparel.
Or T-shirts and stuff.
Yeah. They transport it across the country, and then they literally dump those packages by the pallet into the local post office for the final mile delivery to the consumer's mailbox.
Ah, that makes sense. That completely explains why it's such a low-margin business.
Why is that?
Because you are sharing the revenue with the Postal Service. And the items themselves just don't command a high shipping rate to begin with. Nobody is paying $50 to overnight a catalog.
Exactly. So seeing mail innovations volume decline, while international revenue per piece jumps by 10.7%, it is the perfect reflection of the company's stated strategy.
Customer first, people-led, innovation-driven.
Right. The international market isn't necessarily paying some brand new premium. UPS is just successfully focusing its efforts on the most lucrative freight available globally, while letting the cheap, lightweight mail innovations volume just kind of bleed off.
It really paints a picture of two different companies operating under one shield. The international side is firing on all cylinders, printing double-digit margins, while the domestic side is in the shop, completely dismantling the infrastructure to rebuild it.
That's a great analogy.
So after digesting this completely mixed bag of a first quarter shrinking U.S. volume, massive transformation costs, but booming international margins, where does this actually leave UPS for the rest of 2026?
Well, company management is projecting an almost startling level of confidence going forward.
They really are. The CEO, Carol Tomé, stated point blank that this first quarter was a critical transition period where they needed to flawlessly execute these major strategic actions.
Right.
And then she said, quote, "With that behind us, we expect to return to consolidated revenue and operating profit growth and adjusted operating margin expansion in the second quarter of this year."
So she's saying the worst is over.
Yeah, they're telling Wall Street that the surgery is finished. And to back that up, they are reaffirming their massive full-year targets for 2026.
Which are what, again?
$89.7 billion in revenue and an adjusted operating margin of 9.6%. Plus, they are confirming expected capital expenditures of about $3.0 billion, and this is the wild part, dividend payments of around $5.4 billion.
Reaffirming those targets after a quarter with declining domestic revenue is a very bold signal to the market.
It is. I'm looking at this $5.4 billion dividend payout alongside a $3 billion CapEx plan. And my instinct is that paying out massive dividends while undergoing a radical physical restructuring is incredibly risky.
It certainly seems that way on paper.
Right. You are buying out union contracts, relocating huge machinery, and turning away your biggest customer. How are they not overextending their cash flow here? Is Wall Street just blindly trusting Tomé's track record?
The trust is rooted in the underlying financial health of the core business, specifically the free cash flow.
Okay, let's talk about the free cash flow.
In the first quarter of 2026, UPS generated $1.28 billion in free cash flow.
Over $1 billion in just one quarter?
Right. Now, that $1.28 billion is down slightly from the first quarter of 2025 when it was $1.487 billion.
Okay, so a small dip.
But even with that slight dip, being able to fund a $3 billion CapEx program to buy new planes and upgrade facilities while simultaneously maintaining massive dividend payments, it is a serious high-wire act.
But it proves the immense cash-generating power of the volume they did keep.
Exactly. Management is betting that the shrink-to-grow pain of the first quarter was a necessary, isolated event.
Like pulling off a Band-Aid.
Yeah. By taking the medicine in Q1, absorbing the transformation charges, initiating the driver choice program, letting the low-margin customer walk, they have cleared the operational runway.
So Tomei is confident that Q2 will yield immediate results because the network is now fully recalibrated.
Exactly. The low margin volume is gone, the facilities are consolidated, and the remaining packages are yielding 6.5% more revenue per piece.
The machine is leaner, and the math finally works in their favor.
Precisely.
So to sum up this deep dive, UPS's Q1 2026 earnings report is absolutely not a story of a legacy company helplessly losing market share to newer competitors.
No, not at all.
It is a story of a company intentionally firing its least profitable volume, even from its absolute largest customer.
Which takes guts.
It does. It is a company willingly absorbing massive billion-dollar transformation charges to buy out contracts and optimize its physical network. And it's a company successfully squeezing higher margins out of every single package it decides to keep, especially on the highly complex international side.
It is really a masterclass in prioritizing margin expansion over vanity metrics like sheer market share.
Right, because market share doesn't mean anything if you aren't making money on it. And why should you, the listener, care about the internal operating margins of a logistics company?
Because it affects everyone.
Exactly. Because this isn't just a corporate finance exercise. The efficiency, the pricing, and the structure of this massive global network dictate the shipping costs of almost everything you interact with.
It's true.
The cost of this network is baked into the retail price of the groceries in your store, the medicine at your pharmacy, and every single thing you order online. When UPS decides to charge 6.5% more per domestic package to justify its network reconfiguration, that cost eventually ripples down to the consumer.
Which leaves us with a fascinating macroeconomic puzzle to ponder.
Oh, and I like puzzles.
If UPS is intentionally shedding millions of packages from its largest customer in pursuit of the perfect high-margin delivery, what happens to all that discarded volume?
Oh, wow. Yeah, because those cheap, bulky boxes still need to move from warehouses to front porches.
Exactly. The demand for cheap e-commerce shipping hasn't disappeared just because UPS refuses to carry it.
So will a new, leaner competitor rise up? Or perhaps the Postal Service will have to expand to handle the low-margin deliveries that UPS no longer wants?
Or will everyday consumers and smaller businesses ultimately end up paying the price for this newfound corporate efficiency, as the baseline cost of basic shipping gets pushed permanently higher across the board?
It really makes you think. Checking the pulse of the global economy isn't just about reading the revenue numbers. It's about seeing who is actually carrying the physical weight and at what cost to the rest of us.
Yeah.
So next time you see that brown truck on your street, you might look at the packages inside a little differently.
They aren't just boxes anymore. They are carefully selected, highly profitable assets that actually earned their spot in the truck.
A perfect thought to end on. Thanks for joining us on this deep dive into the underlying currents of global logistics. Keep questioning the numbers, and we'll catch you next time.